Recipes for technical trading success in Cook's Kitchen.
What's driving this bear market rally? Well, it's not really a bear market, but we've had a tremendous relief rally and it's getting away from people. We talked about FOMO a couple of weeks ago, the fear of missing out. We've talked about short covering. We've talked about the easy money forever Fed. What else is driving it? I'm going to suggest the big what if I proposed 3 weeks ago. What if the earnings recession is fully priced in and investors see past the trough? Let's take a look. So this is the chart I show you very frequently. This is what Shiraz Mian, our director of research, puts together. Quarterly earnings growth. You've got the earnings recession in progress, and Q1, which it hasn't even, the earnings season hasn't begun yet, is projected to show negative 10% earnings growth. And as you can see, Q2 is coming in at minus 4.5. My thesis for being cautious to bearish on this market is that those forward estimates continue to be in jeopardy. You're looking at Q1 coming in at minus 10% earnings growth. Well, 6 months ago, it was only minus 3%. So that's an example of how the closer you get to the quarter, analysts start to reel in their estimates, as reality sets in, so to speak. And that can still happen for Q3 and Q4. Let's go back and look at them. So Q4, in fact, 6 months ago, this was probably projected to be 11, 12% earnings growth. It's come down to 8.7. Q1 was, even in January, Q1 was projected to be flat. Now it's minus 4.5. So Q3 is definitely come down quite a bit and in jeopardy. So my thesis about, what if the earnings recession is priced in is, I'm just going to use my hand here to show you, what if this is the trough here for Q1 that we're in right now, which we'll start reporting next month. What if that's the trough and really these don't go much lower? There's your V bottom in the earnings recession, and if investors are looking out and seeing it's not going to get much worse, that's what they're betting on. So that's the question I began asking 3 weeks ago. What if the earnings recession is priced in? It means that stocks do not need to continue the correction below 1,800. Maybe they don't even need to go back to 1,900, but I think they will this year. All right, now we know that oil, the oil bear market is driving this earnings recession. So let's strip out oil. This is a chart that Shiraz also puts together every week. Take out the oil effect. So this is the evolution of Q1 estimates, the quarter we're in now, ending tomorrow, the 31st of March. And so the evolution of estimates, you can see on the bottom, each date marks where were Q1 estimates on December 29th. There you go. Q1 was expected to come in at net minus 1% growth, and that's with energy. You strip out the energy effect, and it was looking for positive growth. Well, you can see how just since the end of 2015, how this has slipped away. And this is what I mean by forward estimates still being in jeopardy, so you can't bank on them. And it just continues to get worse all the way out to, well, let's just look at mid-February. Aggregate S&P 500 estimates were looking for minus 8% growth. You take out the energy drag, and it's only 3.5% growth. So yeah, energy is a big part of this. Energy's half of it. As you can see here, we're looking at minus 5% growth for Q1 on S&P earnings if you strip out energy. Okay, so that's important to talk about, important to realize. But we also know that the oil bear market and what it's doing to the energy sector has spilled over into the manufacturing sector, and that's why we're looking at minus 5% earnings growth for everything but energy in Q1. All right, now what's coming up in April that has kept me bearish? It's redetermination season. This happens twice a year where the banks look at the borrowing capacity of an energy exploration and production company. So they call it the borrowing base redetermination. A lot of big redetermination is a word you're not using every day, but it has a specific meaning in the energy industry. This is an article from the Wall Street Journal. This is either from Deal Beat or the Private Equity Letter. This is from September because they do the redetermination twice a year. They do it in October and they do it in April. So this was a preview for October's redeterminations. And basically what you're talking about is the banks have to look at the E&P and mark their proven assets against the new price of oil. Now, in October, they probably used, most banks and analysts probably used an average price for oil of about $50. They don't change it every week, and they don't change it every month. They do this twice a year. So they have to sort of set a forecast. What's oil going to be at for the next 6 months? And I bet you, oil was bouncing off of 38, 40 back then and got back up above 50. I bet you they were using $50 in October. And what they're doing is, hey, we're going to take your approved reserves and revalue them against this new average price for oil, and then see what your cash flows look like going out, and your debt. And they may not change a credit rating, but it changes the borrowing base for that E&P. And you know how these companies are debt heavy and need to keep funding. So this is a good article. Just Google this, Wall Street Journal, Borrowing Base Redetermination 101. All right. Now, let's flash forward to Q2, taking out the oil effect. Look how Q2 has changed. Same thing. Back at the end of December, Q2 estimates were, not bad, pretty rosy. 1.6% growth, 2.8 if you strip out energy. Look how this has degraded over time. You get into early March, and you finally slip negative. Even when you strip out oil, you go into negative territory. Come to today, and this is as of March 29th, Tuesday this week. Today's Wednesday the 30th. Now you get to minus 1% S&P earnings growth after stripping out energy. With energy, it's minus 4.5%. So, that's why this redetermination season for the banks and energy is a big deal. Because where are they going to mark oil now? They're not going to mark it at 50. I think they'll mark it closer to 35. Everybody says, hey, why is the stock market tracking oil so closely? That's so silly. I think it's silly to even think that, because if it's not obvious, first of all, you have systemic risk with potential bankruptcies as these companies are pumping like crazy and they still can't pay their debts. And then that spills over to the banks. It's obviously spilled over to the manufacturing sector. So now we have these redeterminations, which could force new restructurings, if not bankruptcies. So I think that definitely weighs on the equity markets, and the price of oil is going to set up what this redetermination season looks like. All right, that's enough about oil in the stock market. Let's just talk about, is the stock market overvalued? Here's some simple math. Using an earnings estimate, the consensus earnings estimate for 2016 of $117 aggregate on the S&P, and roughly the price of S&P 2050, that gives you a 17.5 times forward valuation. I contend that that's overvalued, because you can pay 17 to 18 times for forward earnings, and you'd love to if the earnings trajectory is still like this. But the earnings trajectory is like this. So I say that the market is overvalued, trading over 17 times forward earnings that are still in jeopardy. Now, if on the other hand, investors are recalculating their models and they see the trough in the earnings recession, and they're looking out, 6, 12 months, they might see a lot of stock bargains. It doesn't mean the market is fairly valued, but they're still stock picking because the economy is not going into recession. So as long as the economy, the main driver here, is not going into recession, then you remain a stock picker and you try and remain near fully invested. All right, this is the chart I've been showing you since January of my take on what a full valuation reset will look like. I show this to you, every couple weeks. Same deal. Where should valuations be in an earnings recession? and what should you pay for those earnings? So I set up some scenarios here based on, hey, look, we made a lower low in what could be a bear market. First time the market did that on a significant monthly basis, lower low, and so what are we targeting here? In my most optimistic scenario here, I have something like 1725 to 1740, because investors might pay 14.5 to 15 times for that 115 to 120 bucks. Listen, even if I was much more optimistic and said, hey, we can still pay 16 times for $120, those numbers are on here, that would equal S&P 1920, and we're a ways above that. So fair value on this market is a lot closer to 1900 than it is 2050. And March and April are typically strong seasonal months for the stock market, and they may hold off a deeper correction until the summer. That remains to be seen. But bottom line, I'm still cautious to bearish, but watching to see if investors really think that the earnings recession is priced in, they've seen the trough, and things can only get better from here. All right, I'm Kevin Cook. Thanks for watching me in the kitchen.